Happy Kamehameha Day. It's a holiday here in the islands, but Wall Street doesn't care. It just goes on with its business. And today the market closed down. I don't know exactly, it just closed, but it closed down about 850 points. It's been a bloody day on Wall Street. The bonds in particular, government bonds, dropped precipitously again, so more of the same. But I thought I'd message you to let you know what we saw today and what is beginning to stir a little bit for us. We're pretty defensive. Client portfolios have, I don't know, on average maybe 65% cash. They're out of the market with that much money. But still, the part that remains in still hurts a little bit when you have an 800-point down day. We don't own bonds, so we dodge that bullet. But there's no real way to be totally immune from these kinds of moves. What happened today? The inflation numbers came out well over 8.5% for the month. Many economists were calling for lower inflation numbers, and they thought it had peaked. Well, you know what? It hasn't. And our explanation is that there are two kinds of inflations embedded in that number, and it's not acceptable to a lot of conventional economists, but it works. I think what we're looking at is actually happening. The inflation that is caused by too much money chasing too few goods, that's the classic explanation for the inflation reason. That's part of it. That's part of it. And the good news is the core inflation, which does not include food and energy, and they throw those things out. The core inflation numbers today were down about 0.2% on a monthly basis. That's what the Federal Reserve bullets are hitting. But embedded in there is not only core inflation, but we've got this inflation caused by, I just call them stupid policies coming out of the people that run government, and they create an exacerbation that overflows the core inflation fight. So the overall inflation number's 8.5%. Now, that number is a combination of linking 12 of the last months. So if you look at the linkage, there is one more month with a low inflation number, and that's going to be next month. Okay, so when that inflation number comes out, it is going to wipe out the lowest numbers in the pipeline. For example, if that number is a 2% annual rate and we report an 8% annual rate, you include the 8 and you throw out the 2, what happens to the average? The inflation rate goes up, and that's what we're feeling, and the market just jumps because the inflation rate goes up. And yet, coming out of the White House is some more policy boogles that just blow your mind. Okay, now what am I talking about? Bad policy. We're all aware of Biden's cutting the pipelines, cutting the supply of oil, not allowing drilling, et cetera, et cetera. So we've gone from a nation that was self-sufficient. We had enough oil for ourselves, plus we were selling oil to other foreign nations. Now we have a deficiency as a result of policies. And that causes gasoline prices to go up, diesel prices to go up, natural gas prices to go up, and that's all part of this inflation problem. So now the White House this week says, well, maybe we need more ethanol in our fuel. And so the White House mandates all the oil companies, refineries, to put out a different mix of gasoline. But the fact that the government is saying they need more ethanol means what? They buy all the corn in our crop this year. So if the price of corn all of a sudden starts to go up, corn is involved in sweetener, syrup, Fritos, everything else. So the price of food caused by this policy is apt to go up again on the back of a corn increase. right? These are the kinds of policies that just come around and keep stabbing us in the back. So this inflation number continues to move upward, and it's causing a real concern about the market because the Federal Reserve is trying to fight this with a very blunt instrument, and that is the money supply and interest rates. And when they tighten it up, it affects core inflation, but it does not necessarily it doesn't necessarily reflect the stupidity in the leadership of our country. So we just sit here and take it. And the markets sit here and take it, and they're concerned now that since there's no result, the Fed has to get even tougher, raise rates higher and quicker. And if you do that, then there's the confidence that the economy is not going to get hurt, and you prick that bubble, right? So are we in a recession? Maybe we're starting in one. We kind of feel there is, but we also feel that the Federal Reserve's not done raising rates yet. In fact, there's talk about them raising at a full percentage point next week because that's their meeting date. I don't know. But it's enough to scare the heck out of the market, and we've got a big 800 down day. Frankly, on a technical basis, I'm looking at the old low in the market, which is 30,600, and we're down to 31,394. That low was hit over a month ago, and that low of 30,000 came from a high of just about 37,000. So if we test that area, and the market should break that area, that's going to be a very bad technical sign. So we're getting down to that. We're getting down to testing those lows, and this is part of it. But I'll leave one last thought with you. The inflation number is not the real number to worry about. There was another number put out today. Consumer confidence coming from the University of Michigan. That number was 50. Let me tell you, in a normal, healthy economy, that number should be 105, 110. It's down to 50, which means the consumers in America do not have confidence that our economy, nor our leadership, that our country is on the right track. And that means they're not going to do the buying they might do if they were happier. That's a big number, because that is starting to tell the market there's another problem besides inflation, and it's a leadership problem or lack of. Okay, so all of this stuff bears watching, but we still are staying very conservative and trying to keep people out of trouble. And just a random check of portfolios, we're still down around a negative 6 or 7%, and the averages are over 15% down. And the NASDAQ, the over-the-counter market averages, where the high price-earnings ratio technology growth stocks all live, that's down about 28%. So if we can come through this year in single digits and have the market really go through a big correction and not really get hurt, we'd be delighted. We can come back from 6% or 8%. We can't come back from 60 or 40. That takes a long time, and so we're trying to avoid that kind of risk. Anyway, that's the update. Have a good weekend.